Welcome to Invested Intellect, where smart money meets smart minds. Are you tired of confusing investing advice that promises the moon but leaves you lost? What if I told you there's a timeless guide, trusted by legends like Warren Buffett himself, that can teach you how to invest wisely, avoid costly mistakes, and build lasting wealth? Yes, I'm talking about The Intelligent Investor by Benjamin Graham, the ultimate Bible of value investing. In this video series, we'll break down each chapter of this masterpiece into simple, actionable insights that anyone can follow, whether you're a beginner or looking to sharpen your investing edge. So, buckle up and get ready to transform your approach to investing forever. Stay with us till the end, because your journey to financial intelligence starts right here, right now. Let's dive in. What if I told you that the most intelligent investors in history never tried to predict the market? Instead, they followed a timeless principle: protect your capital, stay rational, and invest for the long term. This is Chapter 1 of The Intelligent Investor by Benjamin Graham, the man who mentored Warren Buffett, the world's most successful investor. If you've ever been confused by stock market ups and downs, if you've ever asked, what should I invest in, or if you're tired of speculative noise, then this chapter is your first step toward true financial wisdom. Let's decode what it really means to be the intelligent investor. Chapter 1: Investment vs. Speculation. Benjamin Graham starts the book with a crucial distinction that will shape your entire investment mindset. What's the difference between an investor and a speculator? Investor seeks long-term growth and preservation of capital, makes decisions based on fundamentals, company earnings, balance sheet, value, accepts moderate but reliable returns. Speculator focuses on short-term price movements, invests based on market trends, tips, or emotions, accepts high risk for the chance of high reward, often without analysis. Graham's golden rule: an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. That one line draws the boundary between wisdom and gambling. Adequate, not maximum return. An intelligent investor isn't greedy. Graham says, aim for adequate returns, not extraordinary profits. The goal is capital preservation first and reasonable gain second. Thorough analysis. Don't invest blindly. Study the company. Understand what it does, how it earns money, and whether it's built to survive tough times. Emotional discipline. Most people fail not because they lack knowledge, but because they can't manage their emotions. The intelligent investor stays calm when others panic and cautious when others are euphoric. Graham introduces two broad categories of investors: defensive, passive investor. Wants safety and simplicity. Prefers index funds or high-quality blue-chip stocks. Makes few changes to portfolio. Enterprising, active investor. Willing to research, analyze and monitor stocks. Looks for undervalued opportunities. Takes more effort but has more potential upside. But Graham makes one thing very clear: both types can succeed if they stick to intelligent principles. He strongly warns against market timing, chasing hot stocks, relying on predictions. Why? Because these are based on emotions and guesses, not rational analysis. He says the intelligent investor must be skeptical of forecasts, especially from so-called experts. The future is uncertain. The past tells us a lot more. Key lessons from Chapter 1. Invest, don't speculate. Focus on safety of capital and adequate return. Choose your investment approach: defensive or enterprising. Never forget discipline, patience, and analysis are your best tools. This chapter lays the foundation of intelligent investing. It's not about beating the market, it's about not getting beaten by it. Before we wrap up, here's a question to think about. If markets are unpredictable and emotions are dangerous, then how do we decide when to buy or sell stocks rationally? That's exactly what Chapter 2 explores: the emotional traps of the market and how to avoid being your own worst enemy. Stay tuned for Chapter 2, The Investor and Inflation, where we learn how to protect our wealth in a world where money is constantly losing value. Chapter 2. Summary: Inflation and real returns explained. Inflation is the rise in prices of goods and services over time. It means that the money you have today will buy less in the future. Benjamin Graham warns investors not to ignore inflation when evaluating returns. For example, a 5% return in a year when inflation is 6% actually means a negative real return. You're losing value, even if your portfolio appears to be growing. This is what Graham calls the money illusion, thinking you're doing well because of nominal growth while your real wealth declines. Graham reviews historical data from the early 1900s to the 1970s. His conclusion is powerful. Inflation is real, persistent, and unpredictable. Many investors make the mistake of assuming the past will repeat. Just because inflation was low for a few decades doesn't mean it will stay that way. He gives the example of how the US economy saw very low inflation from 1800 to 1940, but then inflation spiked in the decades that followed, proving that stability can be temporary. The message: don't underestimate the long-term impact of rising prices. Many people believe that stocks are a natural hedge against inflation. But Graham disagrees. He argues that stocks can be just as vulnerable during inflationary periods. For example, in the 1960s and 70s, despite economic growth, stock returns were weak when adjusted for inflation. Graham warns investors not to blindly assume that equities will always protect purchasing power. Market prices depend on investor psychology, interest rates, and expectations, all of which can be distorted by inflation. This insight is one of the reasons why the intelligent investor remains timeless. Graham challenges the myth that stocks are always safe in inflationary times. So what's the solution? Graham doesn't offer a one-size-fits-all answer. Instead, he provides guidelines. 1. Diversify your holdings. Never rely on just one asset class. 2. Don't assume the past will repeat. Low inflation today doesn't guarantee low inflation tomorrow. 3. Include inflation-resistant assets. While Graham himself didn't mention modern options like TIPS or REITs, his principles support the idea of seeking assets that hold purchasing power. 4. Be conservative in estimating returns. Always consider the impact of inflation when calculating your expected gains. Most importantly, he reminds us that no investment is completely safe from inflation. But being aware, rational, and flexible gives you an edge. Let's recap the key lessons from Chapter 2. Inflation silently erodes your wealth. Don't confuse nominal gains with real gains. History proves inflation is unpredictable. Stocks are not always a guaranteed shield. Intelligent investors prepare, diversify, and stay cautious. Graham doesn't try to scare us, he tries to prepare us. And that's the mindset every investor needs to adopt. Be alert, not anxious. Be aware, not arrogant. Here's something to think about. If neither stocks nor bonds are fully reliable in protecting us from inflation, then what should an intelligent investor actually buy? In the next chapter, we dive deep into the most important decision every investor must make: their approach to investing. Chapter 3. Summary: 100 years of market, history, and what it means for you. Graham begins by explaining why it's essential to study the long-term behavior of markets. Markets rise and fall in cycles. Prices are influenced by emotions, wars, depressions, booms, and busts. But through it all, one truth remains. Investors who understand history are better prepared for the future. He warns, those who ignore market history often fall into two traps. 1. They become overconfident in bull markets. 2. They panic and sell low during bear markets. The intelligent investor does neither. Graham breaks down the market into distinct time periods. 1900 to 1949. Slow growth, long bear markets. The Great Depression crushed investor confidence. Annual average return was low. 1950 to 1968. Rapid economic growth. Rising corporate profits. The S&P 500 gave about 14% average annual return, which made many investors overly optimistic. 1969 to 1971. At the time of writing, market volatility returned. Inflation pressures began to grow. Investors were unsure whether the good times would continue. Graham's message: don't assume good times will last forever. High returns attract greed, and greed leads to overvaluation. Another important observation Graham makes is the comparison between stocks and bonds over these years. From 1900 to 1970, stocks generally outperformed bonds, but not consistently. There were long periods like the 1930s where bonds were safer and better. But over very long periods, stocks tended to beat inflation, while bonds often lost real value. Still, Graham cautions, Higher long-term returns from stocks come with higher short-term risks. An intelligent investor doesn't blindly choose stocks or bonds. He balances them based on his goals, risk tolerance, and the market's condition. Many investors, especially during bull runs, assume that past performance equals future results. Graham says this is a huge mistake. Just because the market gave 14% returns in the 1950s and 60s doesn't mean it will do so forever. In fact, periods of high return are often followed by long corrections. So what should the intelligent investor do? Avoid chasing returns. Don't buy into bubbles. Adjust expectations based on valuation, not emotion. Graham also warns against forecasting future prices or depending on short-term predictions. No one can time the market with certainty. So how do we use this market history? Here's what Graham wants every intelligent investor to take away. 1. Use history to build realistic expectations. Long-term stock returns might be around 7 to 10%, not 15 to 20%. 2. Don't invest emotionally. Market history is full of overreactions. 3. Diversify. Even when stocks outperform bonds over decades, there are times when bonds protect your capital better. 4. Buy when others are fearful. History shows that bear markets create the best buying opportunities. 5. Don't rely on short-term trends. Just because the market has been rising doesn't mean it will continue. The past doesn't repeat exactly, but it rhymes. And if you're paying attention, you'll learn not what the next move is, but how to behave when it happens. Here's something important to reflect on. If market history shows that investors get greedy in bull markets and panic in bear markets, then how can you, as an intelligent investor, build a system to protect yourself from your own emotions? In the next chapter, Benjamin Graham introduces the defensive investor and reveals the simple rules for those who want to invest safely without obsessing over the market. If you're someone who wants consistent, worry-free growth, Chapter 4 might change the way you invest forever. Chapter 4 Summary. The Defensive Investor's Strategy. A defensive investor is someone who wants safety first, growth second, doesn't want to spend hours analyzing stocks, prefers simplicity, regularity, and protection over high risk or big rewards. Graham says there's no shame in being a defensive investor. In fact, most people should be. The goal isn't to beat the market, the goal is to not make big mistakes, to preserve capital, and to earn a decent return over time. The defensive investor avoids speculation. He stays away from hot tips, market timing, or trends. He focuses on discipline and consistency. Graham suggests a simple, balanced portfolio made of two main components. 1. High-grade bonds or cash equivalents. 2. Common stocks, high quality, diversified. The classic split he recommends is 50% stocks and 50% bonds. This can be adjusted based on market conditions or personal preference, but it should never go below 25% or above 75% in either category. For example, if the market is overpriced, hold 75% in bonds, 25% in stocks. If the market crashes, flip it, 75% in stocks, 25% in bonds. This kind of rebalancing forces you to buy low and sell high, automatically. If you're not going to pick stocks actively, how should you invest in equities? Graham gives two options. 1. Buy a broad, low-cost index fund like an S&P 500 fund. This gives you instant diversification and requires no stock picking. 2. If choosing individual stocks, follow strict rules. Only select large, prominent, financially sound companies. Companies with long history of dividend payments, at least 20 years. Moderate price to earnings, P/E ratios. Moderate price to book, P/B ratios. Avoid growth stocks with sky-high valuations. You're not chasing hot returns, you want stable, proven businesses at fair prices. Graham prefers high-grade bonds, those that are safe, reliable, and not speculative. These could include US Treasury bonds, high-quality municipal bonds, AAA-rated corporate bonds. In today's world, equivalents might be short-term government securities, fixed deposits, or conservative debt mutual funds. Graham warns against reaching for higher yield in lower-grade bonds. The extra return isn't worth the risk. The bond portion of your portfolio acts as a shock absorber, protecting your capital during stock market downturns. One of the biggest messages in this chapter is this: you don't have to beat the market to be a successful investor. In fact, the more you try to beat the market by timing, speculation, or emotional trading, the more likely you are to underperform. The defensive investor's secret is boring: consistency, discipline, and patience. And in the long run, this approach often outperforms the overconfident active investor who chases trends and panics in crashes. So here's the real question. If being a defensive investor is so simple and effective, why do most people still try to pick hot stocks and time the market? In the next chapter, we'll explore the other side of the coin, the enterprising investor. What does it take to beat the market consistently? What extra knowledge, discipline, and effort are required? And is it really worth it? Stay tuned for Chapter 5, The Defensive Investor and Common Stocks, The Enterprising Path begins. Chapter 5 Summary: The Enterprising Investor's Strategy. An enterprising investor is not a gambler. He is not obsessed with timing the market or chasing the next hot stock. Instead, he is willing to put in extra time, research, and judgment. Is ready to actively manage his investments. Accepts that better returns require more effort. But here's the twist Graham warns. If you cannot devote serious time and discipline to your investing, you are better off being a defensive investor. So if you're enterprising, you're signing up for work, not shortcuts. Before we talk about what to do, let's talk about what not to do. Graham strongly warns the enterprising investor to avoid high-yield junk bonds called second-grade issues, IPOs, initial public offerings, which are often overpriced, hot industries or popular stocks of the moment, over-reliance on forecasts and market predictions. Why? Because these areas attract speculators, not investors. And most people lose money trying to outguess the crowd. The enterprising investor avoids the crowd and instead focuses on neglected, undervalued, or overlooked opportunities. Now, here's what Graham says the enterprising investor can and should do. 1. Buy undervalued stocks. Stocks selling for less than their intrinsic value, often ignored by the market. These require detailed analysis of balance sheets, earnings, and assets. 2. Focus on special situations. Examples: mergers, spin-offs, restructuring. These situations often present temporary mispricings that a sharp investor can take advantage of. 3. Invest in bargain issues. Graham popularized the idea of net stocks, companies selling for less than their current assets minus liabilities. These are rare but very profitable when found. 4. Look for stocks with low price to earnings (P/E) ratios, especially when paired with stable earnings and dividends. 5. Buy quality companies during temporary problems. Sometimes strong businesses go through bad phases. Enterprising investors wait for these opportunities, then invest with a margin of safety. This strategy is not exciting, trendy, or fast, but it works if you're consistent and patient. Graham emphasizes that enterprising investing is a full-time job, or at least it requires regular study, deep knowledge, and emotional discipline. You must understand financial statements, evaluate management quality, study industry trends, maintain a calm mindset during market swings. Without these, even a motivated investor can fall into traps, buying overhyped stocks or panic selling at the worst time. And if you don't have the time or temperament, then go back to being a defensive investor, and that's perfectly fine. The enterprising investor's path is not for everyone, but for those willing to follow Graham's principles, the rewards can be meaningful not just financially, but intellectually. Your goal is not to be clever, it's to be rational, consistent, and humble. It's to find value where others aren't looking, and to hold with confidence when others are panicking. This is not about taking wild risks, it's about taking intelligent actions backed by analysis, not emotion. So here's the big question. If you choose to become an enterprising investor, do you have a system to find undervalued stocks? Or are you just hoping something will work out? In the next chapter, Graham lays out how to analyze stocks and bonds for both defensive and enterprising investors, including what numbers to look at, what to avoid, and how to calculate real value. If you've ever wondered, how do I know if a stock is cheap or expensive? Chapter 6 will open your eyes. Chapter 6 Summary: How to analyze stocks and bonds. Graham defines security analysis as the process of carefully examining financial instruments, stocks, bonds, etc., estimating their intrinsic value, deciding whether the current market price is above or below that value. This analysis isn't about predicting future prices. It's about asking, is this investment worth what it costs today based on real data? Graham makes one thing clear: security analysis is not guesswork. It's based on facts, logic, and conservative assumptions. Graham outlines 3 key roles of investment analysis. 1. Descriptive analysis. What is the company or bond? What are the numbers? Revenue, profits, debts, dividends, etc. 2. Comparative analysis. How does this security compare to others in the same category or industry? 3. Critical analysis. Are the current prices justified based on intrinsic value? Are the future prospects reasonable or overestimated? These 3 steps form the core of how a defensive or enterprising investor should assess a security. When analyzing bonds, the most important factor is safety of principal, not return. For a bond to be worth buying, it should offer a reliable stream of interest payments, a strong likelihood of full repayment at maturity. Graham suggests looking at the company's interest coverage ratio, how easily it can pay debt, the company's debt-to-equity ratio, consistency of earnings over the last 5 to 10 years, stability of revenues and protection against business downturns. For municipal bonds, also consider tax treatment and political factors. The key is, don't chase high yield at the expense of safety. When analyzing common stocks, Graham introduces 2 ideas. 1. Earnings power. Look at average earnings over several years, not just 1 or 2. Avoid companies with unstable or overly optimistic earnings. 2. Asset value, book value. Check whether the stock price is below or near the company's book value, the net assets of the firm. Other important factors: consistent dividend payments, low to moderate price to earnings (P/E) ratio, conservative financial structure, management integrity and track record. The defensive investor should avoid aggressive growth stocks or hype-driven businesses. The enterprising investor may go deeper, but only if their analysis is backed by conservative and rational assumptions. Graham warns, most investors think they are investing when they are actually speculating. If you're buying a stock without analyzing its real value or based on hype, price movement, or tips, then it's not investment, no matter how safe it feels. Investment is only investment when it's backed by thorough analysis, adequate safety of principal, a reasonable return. Otherwise, it's just a bet, and a dangerous one. So here's the question. Have you ever bought a stock based only on price charts, news headlines, or someone's tip without doing real analysis? In the next chapter, Benjamin Graham reveals how market fluctuations affect investors emotionally and how to build the mental discipline to survive and thrive. If you've ever been afraid during a crash or greedy during a boom, Chapter 7 will help you think more clearly, invest more wisely, and finally understand the psychology of value investing. Chapter 7, Summary: The Psychology of Market Fluctuations. Graham explains that the stock market operates in 2 ways: as a voting machine in the short term, reflecting popularity, emotions, and crowd behavior; as a weighing machine in the long term, reflecting true value based on fundamentals. In the short run, stocks may wildly fluctuate based on rumors, headlines, and fear or greed. But over time, the market's true value emerges, and that's when fundamentals win. Graham introduces the famous metaphor of Mr. Market. Mr. Market is your investment partner who offers to buy or sell shares every day, but his mood swings wildly. Some days, he's overly optimistic and offers high prices. Other days, he's pessimistic and offers rock-bottom prices. The intelligent investor uses Mr. Market's mood swings to their advantage. Buy when Mr. Market is irrationally pessimistic. Sell when Mr. Market is irrationally optimistic. But most investors get swept away by Mr. Market's emotions, buying high in excitement and selling low in panic. The key to successful investing is emotional discipline. Graham advises investors to focus on intrinsic value, not daily price movements. Treat market fluctuations as opportunities, not threats. Avoid market timing and emotional decisions. Develop a long-term mindset. Patience is a virtue. This emotional discipline is what makes the difference between an intelligent investor and a speculator. Graham stresses the importance of avoiding herd behavior. When everyone is buying stocks at the top or panicking during a crash, the intelligent investor remains calm and rational. He suggests having a defensive or enterprising investment strategy ready in advance, sticking to your plan regardless of market noise, using market dips to buy quality stocks at discounts, selling when prices exceed intrinsic value even if everyone else is greedy. So here's the question to ponder. Are you letting Mr. Market control your emotions, or are you controlling Mr. Market with your rational mindset? In the next chapter, we will explore the defensive investor's strategy, how to build a portfolio that balances safety and reasonable returns without emotional turmoil. If you want to invest wisely without losing sleep during market swings, Chapter 8 is for you. Chapter 8 Summary. The defensive investor's portfolio strategy. Graham describes the defensive investor as someone who wants to avoid serious mistakes and losses, prefers a passive, hands-off approach, seeks steady returns without constant analysis or speculation, is willing to accept moderate gains in exchange for safety. This investor is not trying to beat the market just to participate in its gains while minimizing risk. One of the core ideas Graham presents is diversification, spreading your investments to reduce risk. He recommends dividing your portfolio roughly 50% in high-quality bonds and 50% in common stocks. Key points include: stocks should be from large, financially stable companies with a good history of dividends. Bonds should be of high quality, preferably government or top-rated corporate bonds. You can adjust this split between 25% and 75% for each category based on your risk tolerance and market conditions, but never go to extremes. This balance protects you during market downturns while allowing for growth in good times. When picking stocks, Graham advises the defensive investor to look for companies with a long track record of profitability, stable earnings over the past 10 years, regular dividend payments, moderate price-to-earnings ratios, not chasing high-growth stocks, financial strength, manageable debt levels. The goal is to buy stocks of solid businesses that can weather market storms. For bonds, the focus is on safety and reliability, avoiding high-yield junk bonds that carry higher default risk, investing in bonds that mature in a reasonable time frame to avoid long-term interest rate risk. Graham also emphasizes the importance of periodic portfolio review and rebalancing. If your stock allocation grows above 75%, sell some stocks and buy bonds. If bonds grow beyond 75%, do the reverse. This discipline keeps your portfolio aligned with your risk tolerance. Here's a question to reflect on. Are you comfortable taking a calm, steady approach to investing, or do you find yourself chasing quick gains and market trends? In the next chapter, Graham discusses the strategy for the enterprising investor, how to actively seek better returns with intelligent research and patience. If you're ready to learn how to go beyond defense and become an intelligent, enterprising investor, Chapter 9 will guide you. Chapter 9. Summary. The enterprising investor's approach. The enterprising investor is more active and involved than the defensive investor, willing to spend time and energy researching investments, looking for opportunities that the average investor might overlook, patient and disciplined in seeking undervalued securities. However, Graham warns that enterprising investing is not for everyone. It requires knowledge, time, and emotional discipline. Graham lists several approaches for enterprising investors to find better returns. 1. Buying undervalued stocks that are temporarily out of favor. 2. Purchasing bargain issues of bonds with a margin of safety. 3. Buying stocks of special situations like reorganizations, mergers, or companies undergoing temporary difficulties. 4. Investing in growth stocks but only when they are reasonably priced. Each of these methods requires deep analysis to avoid speculation and unnecessary risk. A crucial concept for enterprising investors is the margin of safety. This means buying securities at a significant discount to their intrinsic value, so even if things don't go perfectly, the risk of loss is minimized. Without this margin, even the smartest research can fail. While enterprising investing offers the chance for higher returns, it also involves more time commitment, greater risk and volatility, potential for mistakes if analysis is weak. Graham stresses that enterprising investors must be honest about their abilities and limitations. If you're not disciplined or knowledgeable enough, you're better off as a defensive investor. Here's a question for you. Are you ready to take responsibility for your investments and commit time to become an enterprising investor? Or do you prefer the simplicity and safety of the defensive approach? In the next chapter, Graham discusses how to analyze financial statements to make smarter investment decisions. If you want to deepen your analytical skills, Chapter 10 is coming up next. Chapter 10. How to analyze financial statements. In Chapter 10, Benjamin Graham explains the importance of financial statements for every intelligent investor. To make wise investment decisions, you must understand a company's financial health through its balance sheet. Shows what a company owns, assets, and owes, liabilities. A strong company has solid assets and manageable debt. Income statement reveals how much profit or loss the company generates over time. Look for consistent profits. Cash flow statement indicates actual cash generated by operations, which is crucial for sustainability. Graham emphasizes relying on facts and figures, not rumors or market noise, to judge a company's true value. Chapter 11. Security analysis for the lay investor. Chapter 11 builds on this by teaching how to use these financial insights to find undervalued stocks, those trading below their intrinsic worth. Graham introduces simple, practical techniques for the lay investor to analyze stocks without needing to be a professional analyst, focusing on margin of safety and conservative valuation. Chapter 12. Summary. Things to remember about market fluctuations. Graham reminds us that stock prices will always fluctuate, often unpredictably. The market is driven by emotions, fear, greed, optimism, and pessimism. But these swings don't necessarily reflect the true value of companies. The key is your mindset. Don't get swayed by the market's mood. View price drops as opportunities to buy good stocks at a discount. Avoid chasing hot stocks when prices are inflated. Graham famously describes the market as Mr. Market, a business partner who offers to sell or buy shares every day, sometimes wildly optimistic, sometimes extremely pessimistic. An intelligent investor uses market volatility to buy low and sell high, but this requires discipline and patience. Don't try to time the market. Instead, invest steadily and rebalance your portfolio. So here's an important question to consider. How will you train yourself to stay calm and rational, even when the market goes through wild ups and downs? In the next chapter, Graham will guide us through the psychology of investors and common mistakes to avoid. If you want to master emotional control in investing, Chapter 13 is next. Chapter 13. Summary. Investor psychology and common mistakes. Graham explains that the biggest obstacle for investors isn't the market itself, but their own emotions, leading to panic selling during market downturns, overconfidence during booms, and following the crowd instead of independent analysis. Understanding your own psychology is key to becoming an intelligent investor. Graham highlights typical mistakes: trying to time the market perfectly, chasing hot stocks without proper research, ignoring the margin of safety, and letting short-term market noise influence long-term decisions. Avoiding these mistakes requires discipline and a clear plan. Graham advises, stay patient and stick to your strategy. Don't react impulsively to market swings. Focus on the intrinsic value of investments, not price movements, and treat investing like a business, not gambling. Ask yourself, are you ready to control your emotions and build the mindset needed for successful investing? In the next chapter, we'll explore how to value stocks realistically and avoid common valuation traps. If you want to sharpen your investment judgment, Chapter 14 is next. Chapter 14. Summary. Stock valuation. What is a fair price? Graham emphasizes that the true value of a stock is its intrinsic value, the underlying worth based on a company's fundamentals like earnings, assets, and growth potential. The market price can deviate widely from this intrinsic value due to emotions and speculation. To protect yourself from errors, always look for a margin of safety. Buy stocks well below their intrinsic value. This cushion reduces the risk of loss if the market turns against you or your analysis is imperfect. Graham warns against chasing stocks just because they're hot or popular. Paying too high a price, even for a good company, can lead to disappointing returns or losses. Being patient and disciplined is key to finding real bargains. Here's a thought-provoking question. How will you determine whether a stock is truly worth its price or just riding a speculative wave? In the next chapter, we'll explore how to invest in bonds safely and wisely. If you want to balance your portfolio with safer assets, Chapter 15 is coming up. Chapter 15. Summary. Investing in bonds, safety and returns. Bonds are loans you give to companies or governments, and they pay you interest regularly. They are generally safer than stocks, but usually offer lower returns. Graham recommends bonds to reduce overall portfolio risk, especially for defensive investors. Not all bonds are created equal. Government bonds are safest but offer modest returns. Corporate bonds can pay higher interest but carry more risk. Graham warns about junk bonds, high-risk bonds that may default. Understanding bond quality is key to protecting your investment. Graham advises, diversify your bond holdings, buy bonds with a margin of safety, meaning at a price below their value, and be cautious with bonds offering very high yields, they might hide danger. So, the question is, how will you balance your desire for safety with your need for returns in your bond investments? Next up is Chapter 16, where Graham discusses the role of stocks and bonds in your overall portfolio. Chapter 16. Summary. Balancing stocks and bonds in your portfolio. Graham stresses that asset allocation is the single most important decision an investor makes. It controls the level of risk and potential return in your portfolio. A defensive investor might prefer more bonds for safety, while an aggressive investor might lean towards more stocks for growth. Graham advises investors to maintain flexibility, suggesting a 50-50 split between stocks and bonds as a starting point. However, this ratio can be adjusted between 25% and 75% in either direction, depending on market conditions and personal circumstances. The key is to rebalance periodically to maintain your desired allocation. Graham warns against trying to time the market by drastically changing your allocation based on short-term predictions. Instead, stay disciplined and consistent. Here's a question to ponder. How will you decide your ideal balance between stocks and bonds to protect and grow your wealth steadily? In the next chapter, Graham will discuss how to approach growth stocks with caution. Chapter 17. Summary. Approaching growth stocks with caution. Growth stocks are shares of companies expected to grow earnings faster than the overall market. They often trade at high prices compared to current earnings, reflecting future potential. Graham warns that many growth stocks are priced for perfection, meaning any small disappointment can lead to sharp price declines. Investors who buy them without a margin of safety are vulnerable to big losses. Graham suggests, look for growth stocks with solid fundamentals, not just hype. Ensure a margin of safety, don't overpay, and consider growth stocks as a small part of a diversified portfolio, balanced with safer investments. So ask yourself, are you prepared to be cautious and disciplined when investing in growth stocks? Or will you fall for the allure of quick gains? Next, we'll explore the difference between defensive and enterprising investors and how your strategy should align with your personality. Chapter 18. Summary. Defensive vs enterprising investors. Choosing your investment style. A defensive investor prioritizes safety and ease of management. They focus on diversification, high-quality bonds and stocks, and avoiding frequent buying and selling. Their goal is to preserve capital and earn reasonable returns without much effort. An enterprising investor is willing to devote time and effort to research. They seek undervalued stocks, take calculated risks, and use more active strategies to outperform the market. This approach can offer higher returns, but demands discipline and patience. Graham stresses that there is no one-size-fits-all strategy. Your approach must align with your personality, time, and risk tolerance. Choosing the right style increases your chances of success and peace of mind. Ask yourself, are you ready to honestly assess your investing temperament and commit to the strategy that suits you best? Next, we'll dive into practical guidelines for defensive investors to build a strong, low-risk portfolio. Chapter 19. Summary. Defensive investor strategies. Building a safe portfolio. Graham emphasizes that the defensive investor's primary goal is capital preservation with a moderate, dependable income. Avoiding big losses is more important than chasing huge gains. Graham recommends a balanced portfolio split between stocks, typically 25% to 75%, depending on market conditions and personal comfort, bonds, the rest of the portfolio to provide stability and income. Diversification across high-quality stocks and bonds is key. For stocks, Graham suggests focusing on large, well-established companies with a history of stable earnings. dividend-paying stocks that provide steady income, and avoiding speculative or highly volatile stocks. This helps protect the investor from market swings. So here's a question for you. Are you ready to build a portfolio that balances safety and growth without the stress of constant market watching? Next, we'll explore enterprising investor strategies for those willing to take a more active role. Chapter 20 Summary: Enterprising Investor Strategies. How to outperform the market. Unlike the defensive investor, the enterprising investor actively researches and seeks bargains in the stock market. This approach requires patience, discipline, and a thorough understanding of company fundamentals. Graham emphasizes, look for financially strong companies whose stocks are temporarily undervalued, avoid speculative stocks or those priced beyond their real worth, and always maintain a margin of safety to protect your capital from unforeseen downturns. While this strategy can offer better returns than passive investing, it involves higher risk and more work. Success depends on sticking to sound analysis and avoiding emotional decisions. Benjamin Graham's timeless advice teaches us that investing is not about chasing quick profits, but about intelligent decision-making, patience, and discipline. Whether you choose to be defensive or enterprising, the key is to invest with knowledge and caution. Thank you for joining this series on The Intelligent Investor. Remember, smart investing is a journey, not a sprint. If you found this summary helpful, please like, share, and subscribe for more insightful content.